Hi, my name is Jennifer Collins, and I'm going to go over the real estate financing lecture outline from the Modern Real Estate Practice 20th edition, Kaplan Inc. Okay, the reason I'm going over this is because I'm going to be having an exam and I have no idea how to get the answers to these questions right. So I have decided to go ahead and read the outline out loud so that maybe it'll help me to learn this and maybe it'll help you too. So here it goes. Unit 12, Real Estate Financing. The lecture outline goes like this. Housing affordability. Homeownership involves substantial commitment and responsibility. So the decision to rent or buy involves considering the following things: how long a resident will live in the area, personal financial situation, housing affordability, interest rates, tax implications, and the impact of changes in home prices and tax laws. Mortgage terms. Interest rate may be favorable or unfavorable for buyers. Government-sponsored programs may offer favorable terms. Ownership expenses and ability to pay. 1. PIT, principal, interest, taxes, and insurance. 2. Credit score. 3. Debt to income ratio. So that is all under housing affordability. Okay, that was 1. 2, promissory note. A, the borrower's personal promise to repay the debt. 1, will contain the amount of the debt, the time and method of payment, and the rate of interest. 2, it is negotiable instrument held by the payee who may transfer right to future payments by A, signing the instrument over or assigning it to a third party. B, delivering the instrument to the third party. And then B, interest on the promissory note. Okay, we're still under promissory note, the borrower's personal promise to repay the debt, and then the interest. 1, a charge for the use of money, which is interest. And that may be due at the end of each payment period. Interest in arrears, the normal method of interest payment. May be due at the beginning of each payment period, otherwise known as interest in advance. 4, usury is charging interest of maximum rate allowed by law. Federal law exempts federally related residential first mortgage loans from the state of usury laws. So usury laws are charging interest at a maximum rate. Doesn't sound very nice if you ask me. C, loan origination fee, the expense that is paid to the lender to recover expenses in generating the loan. Can vary, but typically around 1% of the loan amount. D, discount points. These are used to increase the yield or true rate of interest required by an investor who would purchase a loan. So the number of points are determined by A, the difference between the interest rate and the required yield. B, length of the time the lender expects borrower to pay off the loan. 1 discount point equals 1% of the loan amount. Calculating discount points and investor yields. E, prepayment penalty. The borrower may pay off the loan in full at any time before the end of the term of the loan or make additional payments to principal during the exam. During the term. You can tell I'm thinking of exam. Penalties may be assessed by the lender to compensate for unearned interest when the loan is paid in full prior to the scheduled end of the loan term. So prepayment penalties may be regulated by state law. Prepayment penalties are prohibited on mortgage loans insured or guaranteed by the federal government or sold to Fannie Mae or Freddie Mac. Okay, security instrument. Mortgage loans are secured loans that consist of the debt itself, or the promissory note, and the security for the debt or mortgage of deed of trust. Hypothecation. pledging property as collateral without giving up its possession. B, a mortgage is a voluntary lien on real estate given by the mortgagor to secure the payment of a debt or the performance of an obligation to the mortgagee. So the mortgagor or the borrower, mortgagor, borrower, mortgagor, borrower, borrower, mortgagor, or the mortgagee, which is the lender, lend, mortgagee, lends, I'm going to lend you the money, mortgagee. All right, that is still confusing. The mortgagor is the borrower. Okay, no, it's not. So I'm going to the bank and I'm going to take out a mortgage, which means I'm the borrower and the mortgagor. Borrower, mortgagor. The lender is the mortgagee. Okay, title theory. The borrower gives the lender the legal title and retains equitable title, meaning they can put money, they have money on the title. Legal title is returned to the borrower upon full payment of the debt. Okay, that's if you're dealing with title theory. Okay, lien theory is the mortgagor or the borrower, retains legal and equitable title. The mortgagee, the lender, has a lien on the property as security for the debt. If the mortgagor or the borrower defaults, the lender must go through foreclosure proceedings to obtain legal title. C, deed of trust. Similar but not identical to a mortgage. Creates a three-party agreement that conveys naked title or bare legal title to the third party, which is the trustee, who has certain obligations to the lender. The beneficiary, the borrower, is the trustor. Borrower, trustor, mortgagor. Borrower, trustor, mortgagor. Okay. Generally provides simpler and faster foreclosure than a mortgage and can be used to secure multiple promissory notes. So the deed of trust is simpler and faster foreclosure than a mortgage. Okay? Borrower, trustor, borrower, mortgagor. Duties of the borrower. Payment of the debt in accordance with the terms of the note. Payment of real estate taxes. The maintenance of adequate insurance to protect the lender's interest in the property. Not to protect anybody else's interest, but the lender. Got to protect the lender's interest. Okay, maintenance of the property to keep it in good repair is the duty of the borrower. You got to keep the property maintained. Okay, lender authorization before making alterations. The duties of the borrower, lender authorization before making alterations. Provisions for the default, though. The lender may accelerate the maturity of the debt in case of default, which is called the acceleration clause. If they are accelerating the maturity of the debt, this is called the acceleration clause. So the lender can step in to pay the real estate taxes or insurance or physically repair or maintain the property. That's the provision for the default on the loan, acceleration clause. Okay, assignment of the mortgage. The note can be sold to a third-party investor. The securing mortgage or deed of trust will be assigned with the note to its purchaser. Assignment of the mortgage. When debt is paid in full or satisfied, assignee is required to execute the satisfaction release of the security instrument. So when the debt is paid in full, the assignee is required to execute the satisfaction or the release of the security instrument. Okay, that's the assignment of the mortgage. The release of the mortgage lien or deed of trust. Mortgage. The defiance clause requires the execution of a satisfaction of mortgage. The release of mortgage or mortgage discharge when the note has been paid. So when the note has been paid, you are required the execution of the satisfaction of the mortgage, which is the defense clause. Okay, that is a question on the exam. The deed of trust requires the execution of a release deed or a deed of reconveyance. Okay, deeds of trust require the execution of a release deed, or if it's a release deed, then it's a deed of reconveyance. Tax and insurance reserves. Tax and insurance reserves are required for some mortgages by the lender called reserve fund, impound, or escrow account. Accounts set up for real estate taxes and insurance premium. Federal regulations limit the amount that can be held as reserves, flood insurance reserves if applicable. So you've got tax and insurance reserves that are required by some mortgage lenders. Not all, they're just saying that this is possible. And federal regulations limit the amount that can be held. Buying subject to or assuming a seller's mortgage or deed of trust, subject to the following. The purchaser is not personally liable for the debt. So subject to. In the event of a foreclosure, the purchaser is not personally liable for a deficiency. Okay. If you're assuming someone's mortgage or deed of trust and they are not personally liable for the debt. So in the event of this foreclosure, the purchaser is not liable. Okay. Assumption. The purchaser is personally liable for the debt. In the event of a foreclosure, the purchaser may be held liable for any deficiency, unless specifically released by the lender. The original borrower may also be liable for the debt or any deficiency. Loan may not be assumed in many cases without lender approval, requiring assumer to qualify. The 3, alienation clause, also called a resale clause, due on sale clause, or call clause, that prevents future purchaser from being able to assume the loan. When the property is sold, the lender can declare the entire debt due immediately. The lender can change the interest rate to the market rate. Okay, recording mortgage or deed of trust. Recorded in the county where the property is located, and it gives constructive notice of the debt and establishes a lien's priority. So that is something you have to know about recording mortgage or the deed of trust. What do we know about recording the mortgage or deed of trust? That means it's done in the county where the property is located. It gives constructive notice of the debt and establishes the lien's priority. Okay. Priority of the mortgage or the deed of trust. Priority is established by the date and time of recordation. It's generally the loan for the purchase of the first lien. Subsequently, recorded loans are second mortgages. Recorded loans are second mortgages or junior liens. The lien priorities can be changed with subordination agreements. Types of loans are going to be straight loan, which means interest only. Periodic interest only payments. Payment of principal in full at the end of the term. Okay. B, amortized loan. Each payment pays interest accrued and partially pays off the principal. Okay. I think that's what most of them are. But C, adjustable rate mortgage. Rises and falls based on the index to which is added margin. So it rises and falls, and the rate caps limits the amount of interest rate that can be paid. Okay, so there's caps, but it is adjustable based on the index. Okay. Which is added to the margin. All right. D, growing equity mortgage. This is also called rapid payoff mortgage with fixed interest rates and increasing principal payments. So it's increasing, which means it's growing equity mortgage. All right. Balloon payment loan has a final payment larger than others. Okay. All right. Reverse mortgage allows homeowner age 62 or older to borrow money against equity in the home. Sometimes I wish I was 62. All right, foreclosure. The legal procedure whereby the property pledged as collateral is sold to satisfy the debt. All junior liens are eliminated. Methods of foreclosure. Provisions vary from state to state. Judicial foreclosure, the property may be sold by the court order. Non-judicial foreclosure, when the power of sale clause is contained in security document. Strict foreclosure. After proper notice is given and the defaulted debt remains unpaid, the court awards legal title to the lender. Deed in lieu of foreclosure. Sometimes a friendly foreclosure. The borrower forfeits any equity in the property and deeds to its lender. Lender must be willing to accept the deed. Any junior lien remains and becomes the lender's liability. The lender loses any rights pertaining to FHA, private mortgage insurance, or VA guarantees. Okay, redemption. Redemption provides the opportunity for a defaulting borrower to redeem the property. Equitable right of redemption. Any time before the foreclosure sale, the defaulted borrower can bring the debt current and have it reinstated. Well, that's nice. Statutory right of redemption. The specific period allowed for redemption after the foreclosure sale. State laws vary widely. So state laws have that's the key word, state and statutory. The specific period allowed for redemption after the foreclosure of the sale. Okay, deed to purchaser at the sale is given after any redemption period has expired, executed by a sheriff, officer of the court, or trustee. Deed conveys whatever title the borrower had. Okay. Deficiency judgment, issued to cover any difference between the amount received at the foreclosure sale and principal balance owed. Becomes a judgment against the debtor. Deficiency becomes a judgment. Okay. Short sale. Sales price is less than remaining debt. Lender must approve and must be disclosed. Consumer protections. Dodd-Frank Act mortgage disclosure rules. Homeowner insurance. Basic form, broad form, comprehensive loss underwriting exchange, which stands is CLUE, and then federal flood insurance program coverage includes overflow of inland or tidal waves, unusual and rapid accumulation or runoff of surface waters, mud flows or mudslides on the surface of normal dry land, or collapse of land along the shore of a body of water under certain conditions. Okay, so we just really briefly went over real estate financing. Don't know if that helps, but there it is. Time to quiz.